I'm pretty sure I'm the oldest member of this panel, so it's probably appropriate that I should fill out what has been said by others with some personal reminiscence, and that is what I will do. I want to go back very nearly 20 years, and I'm sitting in the boardroom of a very large mortgage bank, in fact, the largest mortgage bank in the world. And I've been through a presentation which is around the proposition that the bank should establish its treasury operation as a separate profit centre. Now, running even a very large mortgage bank is quite a simple activity. You have a lot of branches, you take in people's savings, and you branch managers in these branches who lend out mortgages to customers. And if you do that well, you can acquire, as the organisation had, a balance sheet something like 20% of UK GDP. But we were presented with a slide that showed the profits that UK banks, including the second largest mortgage bank, were making from their treasury operations. And after a little of this, I asked the question, given that the aggregate value of government debt and first-class short-term debt securities is essentially fixed, what is the source of the profits that all of these organizations trading in these securities claim to be making? The reaction to that question from the bankers in the room was as if I had made a very rude noise. And I was sent away for re-education so I could have it explained to me by the traders where the profits came from. Well, I spent some time with the traders, and I didn't feel any the wiser about where the profits actually came from. There's a rather sad denouement to this story, which is in 2008, I'm no longer in the boardroom of that particular institution, and it collapses and is rescued by the British government. You may feel that after that period I had got the answer to the question which I had posed 15 years earlier, and I think I did get the answer to that question in 2008. And I want to elaborate that answer a little in what I have to say today. We need to ask the question which Andy's figures posed of why is it that the financial services sector is so profitable? That is, it claims to make returns on equity which are well in excess of any reasonable estimate of a cost of capital. And logically, there are basically three possible elements to the explanation. One is that there is rent generation taking place within the financial services sector, and there is some truth in that. There are oligopolies and various restrictions. The sector may be skimming rents from other sectors, and I think there's some truth in that as well. But there's a third possibility, which is the one I want to focus on, and that is that they aren't so profitable, that the profitability is in significant degree an illusion. But how is it, one's bound to ask, in a modern world of complex and sophisticated accounting, that we can have illusion on this quite extraordinary scale? Well, I think there are three broad parts to that answer as well. The first I call the problem of the generalized winner's curse. Now, many of you will know the basic model of the winner's curse. It's a problem that was discovered in auction theory when oil companies were invited to bid for offshore oil blocks. And what they discovered quite quickly was that the blocks in which they won at auction were not, in fact, the best blocks. They were typically the blocks where their geologists had screwed up in terms of providing the most exaggerated estimates of the volume of oil which was actually in these particular fields. Now, that's a problem in auction theory, which is now well understood, but it's an entirely general problem, which is that where there is imperfect information, and as several people on the panel have explained, imperfect information is not just endemic in financial markets, but the very rationale of financial markets. Where there is imperfect information, assets will be bought by people who overestimate their value, not by people who underestimate them. It's a lot easier to sell a fake Rembrandt to someone who thinks it's real than it is to sell a real Rembrandt to someone who thinks it's a fake. And that's the reason why at any time in the world there exists a large population of overvalued assets, which outweighs the aggregate of undervalued assets. This is the generalized winner's curse, which leads to what Galbraith introduced in his book on the Great Crash, the concept of the bezel, which was the amount of imaginary wealth by which the world was better off when an embezzler had stolen money, but the people from whom he'd stolen it hadn't yet discovered that they had lost it. And of course, Bernie Madoff created the largest bezel ever in history. Charlie Munger, Warren Buffett's partner, used the term fee bezel, functionally equivalent bezel, to describe a bezel that isn't illegal in the sense that Madoff's bezel was, but is nevertheless created by systematic asset overvaluation. And at any time, there is this large reservoir, as it were, of overvaluation of imaginary wealth, which from time to time rises and falls. In bubbles, it gets out of hand, rises to very large amounts, and then from time to time it collapses, as it does in 2007-8. And that's one of the sources of profits that we're describing. The second source of profits is martingale betting strategies. The martingale is a betting strategy which has been known for centuries. And the property of the betting strategy, of the martingale strategy, is that when you lose, you increase your stakes to the point at which if you win, you will recover all that you have lost and a little bit more. And it's a sort of pathological betting strategy because two things are certain. One is that if you carry on for long enough, you will win. And the other is that if you have finite resources and you engage in this game repeatedly, you will ultimately be wiped out. So this is a pathological strategy which people are generally recommended for these reasons to avoid. But you will understand that the martingale strategy is one that is followed, almost invariably the one followed by so-called rogue traders in financial markets. And more moderate versions of martingale strategies are built in to a wide variety of trading and financial services sector strategies. At its simplest, for example, the model in which you supply people with collateral for a loan, which is not actually a fixed asset as collateral, but is collateral up to a certain value, that is a transaction that has an essential martingale property built into it. The converse of the martingale is the St. Petersburg paradox, another problem that hasn't been known for centuries, which is the problem in which is the bet in which you have you play the game until you win, and every time you lose, the amount which you can get is doubled up. And the paradox is the fact that this is a game that has infinite value, but no sensible person will pay more than a rather small amount for it. So there's a divergence between expected value and market value, and a divergence between the two, which can be managed rather effectively by people who have a banking book in which things are marked to essentially to expected value, and a trading book in which things are marked to market value. So the martingale and the St. Petersburg paradox is the second theme. And the third theme is simply writing heavily out of the money options. This is a strategy which wins on the vast majority of occasions, but occasionally loses, and the amount that you're out of the money when it loses is very large relative to the amount by which you're in the money when you gain. It's the trade that pays on 90% of occasions, but does not pay overall. And many of the vast majority, for example, of hedge fund strategies designed to produce regular patterns of stable returns have essentially this out-of-the-money option property about them. All of these things taken together, the Martingale-St. Peter's paradox problem, the Ponzi scheme, the winner's curse, and the bezel for bezel, and the out-of-the-money option strategy, I think the vast majority of trading strategies in financial markets follow one or other, or indeed in the case of some of the modern financial innovations, actually they are neat instruments that build together elements of all of these strategies. In fact, if you look at some of the more complex securitized obligations that were created back in 2006, 2007, you can find elements of all three of these strategies built into them. Taken together, they create what I regard as the tailgating problem. I drive quite a lot in France, where you discover if you drive at less than 130 kilometers an hour on the motorway, there will be someone behind you flashing his lights. And the property of the tailgating activity is that it pays most of the time, but sometimes it leads to extremely large losses. Now, the people who engage in that strategy congratulate themselves on their skillful driving, and a kind of cognitive dissonance comes into play in which the occasional accident is attributed, generally with good reason, to some external cause rather than the underlying behavior which gives rise to the cause of it. So this is what is going on, and this is the complicated answer to the question to which I failed to get a proper response when I posed it 15 years ago. But I think there's a very fundamental implication, if one thinks in this kind of way, to the way we should view a wide variety of trading activity in financial markets and its consequences. We're inclined to say this is what we see, the problems that are created, as in 2007, 2008, are, as it were, the froth on the top of basically a reservoir of value added. But it may be that there is essentially nothing but the froth, that in the absence of the kind of asset valuation mispricing that I've described, most of the trade which occurs in these markets would not actually take place. That is, if we were to regulate these activities effectively, and I can't imagine how we could do it, to eliminate asset mispricing, these activities would no longer occur. As we should all have known if we had read George Soros more carefully 20 years ago, we ought to know that these activities are not, as it were, an aberration in the behavior of financial markets. They are actually fundamental to the nature of the financial markets we have today.